Okay, this is not a great time to be an investor. There's a ton of red across the board, and today we're going to talk about it. We're going to see what the internet is saying about this topic and all of their infinite wisdom. Then I want to give you guys my analysis. We're going to look into the actual data and try to get some kind of insight from it. And then finally, I came across a very insightful article on Yahoo Finance talking about potential good investments over the next year, considering the latest economic data. But first, we have to begin with all of the pain and suffering in my portfolio. If you guys enjoy the content, make sure to leave a like, subscribe. It's really useful. So just in the past one day, the market is down about 2.5%, and my portfolio is doing a little bit better, down 2.18%. But I did get a nice $70 dividend today. And here's the exact breakdown of how each segment of my portfolio handled. So my broad market index is down 2%. If I click into it, this is the exact breakdown. And JEPI, this is no surprise, in this volatile market, this conservative ETF is doing a lot better than the benchmark. And JEPI has been performing extremely well this entire year, and that's why it's become one of the fastest growing ETFs on the entire market. My growth and technology assets are down the most, as you would expect, 2.64%. Here is the breakdown. Somewhat surprisingly, BST is holding up a lot better than the broad market VGT. I'm not sure why that's the case. BST is a very volatile ETF, but it seems to be doing a little bit better right now. And then my value assets are down the least, as you would expect, 1.82%. And again, the actively managed ETF, in this case Divo, is doing a bit better than the passive market index. But regardless, this is a tough market. I'm still down 2%, over 2% in just one day. And of course, the major catalyst we had this month was the CPI report for December. And it came in below expectations, 7.1% versus 7.3% expected. So not only does it continue the downward trend, but it's a faster downward trend than we were expecting. So then why is the market still giving us all these red days? Well, according to Reddit, we were expecting a 50 BP rate increase, and we got a 50 BP rate increase. This guy bought call options, so maybe that's why the market is down today. But then this guy says the Fed officials also forecasted raising rates to 5.1% before it ends this hiking cycle, perhaps a little bit higher than traders were expecting. The Fed also forecast that it would keep rates higher through 2023 with no reductions until 2024. And that's basically exactly what happened. So the Fed had their meeting on December 14th. Jerome Powell got behind the mic, and they essentially said they have to continue to aggressively fight inflation, keep rates high for longer, and that's why the market is having a hissy fit. And here's the official summary of economic projections. There's a few notable things I can point out here. So one thing the market didn't like is this number right here, which is the change in real GDP for the year 2023. And the reason why the market didn't like this is because they revised it way down to just 0.5%, confirming the fears a lot of us have that in 2023, we're gonna face some kind of a recession. And the next thing the market definitely didn't like is this dot plot right here. So this represents the FOMC participants' assessments of appropriate monetary policy. And if I was to draw an average kind of line going through the dot plot, it'll look something like this. And of course, this represents the federal funds rate. The big thing the market didn't like is all of these dots up here indicating the terminal rate being well above 5%. The market was hoping that after the positive CPI report, the terminal rate would stay below 5%, but unfortunately that doesn't seem to be the case. So that's the current situation we find ourselves in. The previous two CPI reports were actually very positive and came in below expectations. However, even in the face of that data, the Fed is being very hawkish, indicating that the terminal rate is going to be above 5%. They're going to hold it there for a long period of time, and it's stoking fears that they're going to cause a recession next year. And that's what this article is talking about on Yahoo Finance. So from BlackRock, they're saying that central banks are now deliberately causing a recession. And they also recommend a few shock-proof assets to consider in that environment. So their main point here is that in the past, when the economy entered a downturn, the Fed typically stepped in to help out the economy. But they're saying that this time, due to the nature of this recession, don't count on the Fed actually helping out the economy. Central banks won't ride to the rescue when growth slows in this new regime, contrary to what investors have come to expect. So if this recession does turn out to be different from previous ones, maybe it's time to look for unconventional ways to hedge against it. And here are 3 assets to consider. The first one they give here is real estate. So it may seem counterintuitive to have real estate on this list because when the Fed raises the benchmark interest rate, mortgage rates tend to go up, and that should technically hurt the real estate market. So they say while it's true that mortgage payments tend to rise, historically, real estate has actually demonstrated a resilience in times of rising interest rates. It also helps that real estate is a well-known hedge against inflation. So as the price of raw materials and labor goes up, new properties become more expensive to build, and that drives up the price of existing real estate. So do you guys agree with the article? This is the ETF ticker VNQ. It's the Vanguard Real Estate Index Fund. And so far, year to date, it's down 22%, or actually year to date 25%. So far it hasn't been a great hedge, but who knows, maybe next year in 2023, it'll be a different story. And let's go ahead and toss up O, Realty Income Corp. And yeah, this is down 9.21%. Better than the market, but still not great. The next one here is good old consumer staples, and whenever there's a recession, these are usually the go-to names. These include products such as food, drinks, household goods, and hygiene products. And the basic idea here is that no matter what the economy is doing, or what the Fed is doing, people need to buy food, drinks, and hygiene products. So ticker VDC is the Vanguard Consumer Staples Index Fund, and year to date, it is doing pretty well, down just 3.83%, and over the past 5 years, it looks like this. Let's toss up PG. This is Procter & Gamble, a consumer staple company, and year to date, this is down 7.24%. So maybe this indicates that if you want to go down this strategy, instead of stock picking, it might be a better idea to choose a broad market index fund. So yeah, that's the current state of the market. And personally, I don't think I'm gonna change my strategy at all. I'm pretty happy with my current configuration. I'm just gonna continue to dollar cost average into these investments. And long term, I'm pretty confident in the ability of this to do well. That's gonna do it for the video. If you guys enjoyed, leave a like, subscribe, and I'll see you in the next one.